Hello everyone, welcome back to chapter 3, Determination of Income and Employment. In our previous video, we studied consumption and saving and learned about APC, MPC, APS and MPS. And today we are going to connect those topics with another important component of this chapter, which is aggregate demand and investment. So, but exactly what investment means in economics, macroeconomics specifically? And how does investment affect the income of an economy? And more importantly, how does an economy reach its equilibrium level of income? These are questions we'll answer today. We'll learn two important conditions for equilibrium, that is AD is equals to AS and S is equals to I. Don't worry if these equations look confusing right now. By the end of today's lesson, you'll understand exactly why these conditions repeat and represent equilibrium. Let's begin with the meaning of investment. In everyday language, we often use the word investment when we talk about buying shares, mutual funds, gold or property. But in class 12 macroeconomics, investment has a more specific meaning. Investment refers to expenditure on capital goods such as machinery, equipments, factories, buildings and other assets that help in production. For example, suppose Tata Motors purchases new machines for its factory. These expenditure is considered investment because those machines will help the company produce goods in the future. Similarly, if a company builds a new factory, that's investment. If a business purchases new equipment or technology to increase production, that is also investment. So remember, investment in macroeconomics is mainly related to capital formation and productive capacity. It's not simply the purchase of financial assets like shares and bonds. So buying shares doesn't mean investment expenditure in national income sense. Investment expenditure refers to capital goods and inventory. Investment can be understood in different ways. First, we have fixed investment. This refers to expenditure on fixed assets such as machinery, factories, buildings and equipments. Since we have inventory investment, inventory means stock of goods held by firms. For example, suppose a company planned to sell 10,000 units but actually sold only 9,000. The remaining 1,000 units become inventory. The change in inventory is part of investment. We also distinguish between planned investment and actual investment, which we will discuss shortly. So for your examination, make sure you understand these distinctions rather than simply memorizing the names. Now let's understand an important term, autonomous investment. Means independent. Autonomous investment is investment that does not depend on current level of income. For example, suppose the government decides to build a new highway. The decision to construct that highway may be based on infrastructure requirements rather than the current income level of the economy. Therefore, if income changes, the autonomous investment may remain unchanged. This is different from investment that respond to changes in income. For example, if businesses see higher demand because people's income have increased, but they may have invest more in machinery and factories. But autonomous investment is considered independent of income. In many textbooks, models of income determination, autonomous investment is assumed to be constant. So autonomous means independent. Now let's understand the difference between planned and actual investment. Suppose a company plans to invest 100 crores during the year. This is planned investment. But imagine the sales are lower than expected and company is left with unsold goods worth 10 crore. Those unsold goods become inventory. Therefore, actual investment becomes 110 crores. So actual investment is equals to planned investment plus unintended inventory investment. This distinction becomes particularly important when we discuss equilibrium. At equilibrium, there is no unintended accumulation or depletion of inventory. Therefore, planned investment and actual investment become equal. Now let's connect investment with the rest of economy. Suppose businesses decide to invest more. For example, a company builds a new factory. To build that factory, it purchases cement, steel, machinery, equipment and other goods. This creates additional demand. As demand increases, producers increase production. To produce more, firms may hire additional workers. Those workers earn income. Higher income can lead to higher consumption, and higher consumption creates even more demand. So investment does not affect only the company making the investment, it creates a chain reaction throughout the economy. This idea will become extremely important when we study multiplier later in this chapter. Now we have come to central concept of this chapter, equilibrium level of income. We already learned that equilibrium means state of balance. In income determination model, equilibrium occurs when aggregate demand equals aggregate supply. In other words, the amount that people and other sectors plan to spend is equal to amount firm plans to produce. Suppose firms produce goods worth rupees 1 crore. If planned expenditure is also 1 crore, everything that firms plan to sell is purchased. There is no unintended accumulation of inventory. Therefore, firms have no reason to unexpectedly increase or decrease production. This is equilibrium level of income. Remember, AD is equals to AS, that leads to equilibrium. This is one of the most important conditions in this chapter. Let's understand what happens when the economy is not at equilibrium. First, suppose AD is greater than AS. People want to buy more than firms have produced. Existing inventories start falling. Firms notice that their stocks are declining, so they have an incentive to increase production. As production increases, income also increases. Eventually, the economy may reach a point where AD becomes equal to AS. Now take the opposite situation. Suppose AD is less than AS. Firms have produced more than what people want to buy. Unsold inventories begin to accumulate. Firms respond by reducing production. Lower production reduces income. Again, the economy moves towards equilibrium. Therefore, the economy tends toward the point where AD is equals to AS. Now, there is another way to determine equilibrium income, the saving investment approach. Let's derive it logically. We know income is equals to consumption plus saving. So, Y is equals to C plus S. We also know in the simple two-sector economy, aggregate demand is equals to consumption plus investment. So, AD is equals to C plus I. At equilibrium, AD is equals to AS. So, C plus I is equals to C plus S. If we cancel C from both sides, we get I is equals to S, or S is equals to I. So the second important equilibrium condition is saving should be equal to investment. This doesn't mean that household directly give their savings to firm. It's an equilibrium showing that planned saving is equal to planned investment in simple income determination model. Let's finish today's lesson with a simple numerical example. Suppose consumption expenditure is 500 crore and investment expenditure is 200 crore. In a simple two-sector economy, AD is equals to C plus I. Therefore, AD is equals to 500 plus 200. AD is equals to 700 crore. If aggregate supply is 700 crore, then aggregate demand equals to aggregate supply. Therefore, economy is at equilibrium. The equilibrium income is 700 crore. Before we finish, remember the two conditions we have learned today? The first is AD is equals to AS and second is S is equals to I. Both conditions help us identify equilibrium in the income determination model. In our next part, we will move into an extremely important concept, underemployment equilibrium and full employment, followed by inflationary and deflationary gaps. Make sure you understand today's concept because they will be used again when we study the multiplier and numerical questions. So, if AD is 900 crore, AS is 800 crore, is the economy at equilibrium? Find and comment your answer in the chat box. I love to read. Till then, take care. Bye bye.